Welcome back to Online Trading Summit. Our next speaker is Andrea Unger, who is renowned for being the only trader to ever win the Futures Trading World Cup Championship 3 years in a row. A few years later, he went on to win the 4th championship to become the tournament's only 4-time winner. In this presentation, Andrea shared how he got started in systematic trading and illustrated his comprehensive 6-steps process to building a systematic trading strategy. There are tons of systematic trading wisdom from him, so make sure you hang on to hear what he has got to share. Hi, Andrea.
Hi, Philip. Thanks for letting me be here.
Yeah, welcome to the Online Trading Summit, and we are really very honored to have you coming on board to share with these summit participants about your experience and your trading knowledge. And I'm very excited, and I think that this is going to be a really great session. But before we go into the part where you're going to share with us how to become a trading champion, so maybe just very quickly, would you be able to share with me and the summit participants how, in the first place, do you actually get started in trading? When was that? How long ago was that? And how did it evolve in terms of your trading experience along the way? Maybe you can just quickly share with us something about that.
Yeah, actually, that's a long time ago. It was in the past century. I was still working. I'm a mechanical engineer. I have a Master of Science, and I was working in some multinational companies, technical marketing, and obviously with some colleagues, we were interested in making some extra money. So we started investing in in a stock market, mainly based on rumors. We even purchased the shares of a company where I was working for. I started getting interested in that. That was maybe 97, something like that. And we did make money at the very beginning. So I felt very smart. I lost all that money and I lost more of that. But I didn't want to quit because I didn't like to lose money. It was more sort of a losing thing that I didn't accept. I felt to be smart enough to figure out how markets were. So to see that I was losing the money was something that was upsetting me, not only for the money, but also for the fact that I got a failure, you know. So I started studying. I started studying and trying to understand. So I started studying, I discovered technical analysis, and I started more or less on all those topics most of you probably study: head and shoulders, moving averages, indicators, oscillators, all things like that. And I kept on losing money. But slowly, I started improving, slowly. Then I discovered some inefficiencies on Italian market with some instruments. They were called covered warrants, and they were options with market makers. And these market makers had some slow software so that the quotes were coming out a bit late, maybe 5 to 30 seconds later than they were supposed to be, based on the underlying moves. Being able in maths and making some quick calculation, I was able to figure out if there was room for an arbitrage, and there was. So I started making money. At the same time, I realized that the banks, the market makers, would not keep on forever in going out with such a poor software. And I was trying to prepare myself for the future. What shall I do when this thing is over? Because in the meantime, I also quit my job. So I became a full-time trader. I was making money, so I became a full-time trader. I said, being a mechanical engineer, I felt that even if after 1 or 2 years, I realized that it was not for me, I could still be able to find a job. So I was relaxed enough to start this adventure. I started studying. I understood that the best thing to do for me, for my mindset, was to try to find a way in automated trading, developing trading systems based on backtesting, on numbers. Because having a mathematical mind, I was looking for numbers and fixed plans. So I started developing, and I tried to put the rules I knew from common sense into the machine. It was a disaster. Then I started trying to mix all sorts of indicators together to find the best ever setup. And that was another disaster. So I started thinking it was impossible. I will never find my way. But I didn't want to quit. And I had a friend, I still have a friend, and he said, look, I know you are a smart guy. I want you in my team to help me in developing strategies. And he passed a very simple piece of code over to me. This is the starting point. We developed on this. So when I saw that, I said, can it be that simple? And it was. Starting from that tiny piece of code, I built all the environment you probably have heard about today. Because starting from there, I understood that it was possible to develop strategies based on a simple process where you put all things together. It's like when you build a cathedral, you put all the bricks together. You have a plan, but you put all the bricks one after the other. And at the end, you have your building, your cathedral, or whatever you prefer to imagine. I started with that. And then having the first profitable strategies, I was able to work studying further with a more relaxed attitude, because I already had something that worked, and I had just to think about other ways of making profitable trading systems. So that was one way. Year after year, adventure after adventure, I found other models to build systems out. And today it's what I use. I have some basic models, and on these basic models, I put strategies with rules one after the other. I will show you later on an example of my approach, how I start from something, and then I build brick after brick the final product, which is then what you put live. It's not that difficult once you get the right ways to go. I decided to go with systematic trading because I believe that it helps psychologically. Obviously, once everything is in the machine and running and you made all the decisions in advance, then it's easier to stay in the markets, because when you are a discretionary trader, you have to make decisions during the activity. And during the activity, you are under stress. If you are losing, or even if you are making a lot of money, you feel stress, and stress does not help, obviously, in making the right decisions. While on systematic trading, you measure your idea with backtesting, and once you measured your idea and you believe it's a good idea that works, you just put it live and the machine does the job for you. In addition, the computer can handle a number of tasks. We as human beings can trade maybe 1, 2, 3 markets, certainly not 30 markets or 40 or 50. The machine can. So once you develop all the systems, they can work. They don't need our direct mouse clicking to go ahead. And also, I remember once I was purchasing some shares, and I entered the market with a supposed size of 10,000 shares. And I saw that as the very moment I clicked on the mouse, the stock jumped up, the prices. Oh, I'm so good, look, I'm entering and it immediately boosts. When I saw that there was something weird, And I discovered that it was me moving the share because by mistake, I entered 100,000 instead of 10,000. So those 100,000 size was actually moving the prices up. So I was pushing prices to the sky. But I had a problem because then I had to get rid of the extra shares, trying to lose as small as possible. So I was really struggling with that situation. I was able to manage it somehow with some patience, but based on that, I also understood that a computer would not have made that mistake, because once you program the size into the machine, it doesn't add a zero or things like that. So,
I see.
I mean, just one more reason to prefer systematic automated trading to discretionary. There are many other reasons, but this is just some to explain to you and to all listeners why I actually prefer a systematic approach to the classical discretionary approach.
I see. So was all of this systematic trading implemented even before you joined all the trading competition? And during your competition, were you actually using systematic ways to trade?
Part of it, yes. Part of it because I'm still learning and developing today. So it's an ongoing process. But as you mentioned, the competitions, you know, I won the World Cup Trading Championships in 2008, 9, 10, and 2012. And I did that using trading systems. The first editions were with trading system running on my computer, but the orders were still placed manually because technology was not to the level it is today. That tried 10 years ago, you know. But then I implemented in 2010 the whole totally automated structure, and I had the trading system. Both competitions helped a lot in developing my skills as well, because in the competitions I learned how to react to markets which were changing. Let's say the behavior of the markets in 2008 was completely different from the behavior in 2009, and again in the behavior in 2009 and in 2010 and in 2012. So understanding that the markets were continuously changing and having to react to find the right solution quickly, because you have a 1-year contest, you have to react in the 12 months because you have to make the best performance in 12 months. So I was able to increase my adaptability to the markets, my skills to react on time as quickly as possible, to figure out what's going on, if something is changing, and what to do, which strategies should be in place. On the contest, you have a small account. It's all real money, but still small money. It's about $15,000 US dollars in the very start, and then they went down to 10,000. So you cannot trade 50 strategies. You have to choose the strategies you believe should be those who will do best. So that is very useful to be able to stay in touch with the markets. So I suggest to do it, not to win. I mean, obviously, who participates wants to win, but it's also something that can increase your skills in terms of making the right choices.
I see. Great. So I think right now we are all looking forward to have you share with us how you actually went about achieving that kind of really good results in your competition. So I'm going to hand over the stage over to you right now, Andrea, and look forward to you sharing with us your experiences.
Okay, I will show you just some tips to becoming automated trader, and I will show you a step-by-step process or how I face the market. It's just an example. It's one out of tens of examples, but I hope it will be useful. So let me show you this. Okay, I hope you see it. That's me. Okay. So I called this trading systems attempt as it is an attempt from us, but again, just some quick words about me. I told you I won 4 times. I'm the only trader in the world who managed to win 4 times. I also said that I have a Master of Science in Mechanical Engineering. I don't know if this helped or not, because I've always been an engineer when I was a trader. So maybe being an engineer helps, maybe it's useless, I don't know. And I retired from my job in 2001. Since then, I'm a full-time professional trader. I also wrote a book about money management, position sizing. This book is available in Italian and in Chinese. It has been translated into Chinese. And I am a honorary member of SIAT, the Italian Society of Technical Analysis, which is part of IFTA, the International Federation of Technical Analysis. I've been invited as a speaker all around the world, virtually, as today, but also physically. Sometimes I've been most parts of the world to discuss about trading. So trading system attempt. What do I mean with attempt? Well, it might be dangerous as what you see here, but don't be afraid. Attempt keeps in its word a number of characteristics you have to go through to get something in trading, in automated trading. First of all, analysis. Then testing. You have to test. This is the key. I test what I do because I want to know if at least in the past it showed to be profitable. Tuning. Once you have something that works, then you start doing something to improve it even a little bit more. Evaluation. This is important because when you have something that works and is good, you have to evaluate if it's really good and also if it is good for you. Because if I give you my best strategy, for example, and it makes money, it doesn't mean you will make money with it. Because if for some reason, psychologically, that kind of approach doesn't meet your mindset, then you will have problems. Because you will do something that will harm the results of the strategy, for sure. Then evaluate money management. As I said, this is very important. The proper size to keep risk under control and at the same time to maximize the potential of a strategy. Portfolio. I always spoke about strategies, which means one single system can help but will not make you rich. You need to face the markets as a whole. You have to try to diversify as much as possible. And the portfolio of strategies is the key, is the target you have to have in your mind. And then trading. Once you have everything put there, you have to put it on your computer to let it go and trade. And also in this case, you have to make the right choices in terms of software and generally infrastructure. Let's see, let's start from the first point, which is the analysis. This is very important. Each market needs investigation. You have to investigate on every single market you want to trade. In terms of liquidity, is this market liquid enough? Are there enough volumes to trade with no problems? In own characteristics, every single market has a different way to move. You have to understand what main characteristics are there for every single market you are interested in. This is extremely, extremely important, believe me. The literature out there is telling you that a robust strategy has to work on every market, every time frame. I don't know if I'm allowed to say that that is bullshit, but it is bullshit because such a strategy does not really exist. This, to find out what every market shows as characteristics, is extremely, extremely important. And you have to be very careful about this. The type of moves a market shows, what kind of moves are more recurrent in a market. You have to try to find out. In your analysis, you have to find out if there is something specific in this area. Obviously, now you might argue, okay, I like this. How do I analyze? What shall I do? And we know, we read sometimes about econometric tools, GARCH, and things like that. Everything is very useful, but when you use those science, let's say, on one side it's even very difficult, in my opinion. You need to have a good knowledge to use it. But okay, let's imagine you have this knowledge, which is fine. But the point is that once you use these tools to investigate, at the end of your analysis, you have information about the markets, but not about the trading style. You may know something about the market, but you have to translate this something into an approach. So actually, I don't suggest to use these econometric tools to do, but I suggest to simply simulate trading strategies. You simulate trading and you see what happens. One step back, I spoke about, because we'll see this simulation on strategies. Here I will show you some markets, and I will tell you what I look at when I analyze the markets. This is the Italian future. I show it here just because I'm in Italy, but it doesn't really matter. This is a daily chart, and I have two indicators here at the bottom of a chart. One indicator is the volume, the one in the middle. Everybody knows about what volumes are. The second indicator is a custom indicator which shows the dollar move of the market. What does this mean? You could measure volatility in indicating the range of the daily move or an average range, whatever you prefer. But I prefer to translate this into the dollar move. So if my market moved from here to here in one day, from 100 to 110, how much did actually this mean in dollars? How much having one contract of this market would I have seen moving my account due to that move? And I do it here. I multiply the range of the daily range by the big point value, which is the dollar value of 1 point move in the market. And I know how much in money this market is moving. Here, I get an information about also how heavy, risky, and expensive a market is. If I don't have a huge capital, I would not be able to trade markets that show excessive dollar moves, because those would be too dangerous for me. Here you see we have roughly $2,000, okay? So this is a benchmark for me, but you can choose any other market to have an idea. If this market moves $2,000, I can tell you from my experience that if you try to build an intraday trend following strategy on a market, your stop loss should be, as a starting point to develop, around 60, 70, let's say 70% of the daily range, okay? In this case, we would be around $1,500 stop loss. So now it's up to you to say if this $1,500 is too much for your capital, or if it is something affordable. If you trade with $10 million, it's not a problem. But if you trade with $10,000, that would mean 15% of your account, and that's absolutely too much, of course. So let's see. This is the mini future of the Italian future. And here you will see that the volumes are still good, and the dollar size is much, much smaller because it's a mini contract. DAX future, you know this probably. Don't care about the yellow box. That's something of another analysis, which is not important here. The volumes of the DAX future are about 100,000 contracts a day. So this is a very liquid and good market to trade. Why are the volumes important? Because if there are a lot of volumes, you are you are relaxed trading that because you know you will find somebody to sell your contract to or to buy from if you're short. If there are not volumes, you might be in trouble if something happens because you would not find any good counterpart to sell or buy to. And then the dollar move, this is a euro move, but it doesn't really matter. 3,500 here, and even more sometimes. This is a very expensive market. So the DAX itself is only for people who have a good capital to trade. On the other side, there is the mini DAX. The chart is shorter because the contract was born in 2015, but this is 1/5 of the big DAX. So this is something that in some cases could be affordable to many traders. So if you like the way DAX moves, but you don't have enough capital to trade the DAX, you might consider the mini DAX, or in alternative, the CFDs that some other brokers offer on the index. Mini crude oil. I'm talking about futures here. Crude oil future is expensive. Mini crude oil is something that can be considered because it has enough volumes, and you see it here, and it is 50% of a big crude oil contract. So again, if you're looking for some cheap markets, mini crude oil could be a choice in case you like the energy sector and especially crude oil market. Mini gold is not good. Volumes are very small, 366,000. This is nothing. So mini gold, if you like gold and you want to trade, don't choose mini gold. Mini gold is something you should not imagine to trade because you will have trouble. On the contrary, you could try to trade micro gold because micro gold has good volumes and a very affordable size because it's 10% of a big gold contract. So this is something that might be useful for you who want to trade, not needing too much money. Now, this is just some tips for those who are not heavily capitalized, but I think it's important to know because apart from the CFDs or the Forex where you can scale down, who wants to trade the futures market just because he wants to choose a regulated market? These were some tips to choose from the futures which are more affordable with small amounts of money. Now let's go another step further. We saw something about volumes. I also mentioned about the characteristics of the markets. I can tell you, basically, markets divide in two categories. Category of trending markets and mean reverting markets. What does it mean? Some markets have a behavior where normally once you have a breakout of some level, up or down, then that market tends to continue moving in that direction. There is a tendency to escape in the direction of the breakout. On the contrary, some other markets have a tendency to fade the breakout. You have a breakout and then a pullback, or to the downside, you have a recovery. On the long term, markets are still trending because some markets go up, some markets go down. We have changes which are linked to the economy, to the financial situation. But on a shorter term, I can tell you, some markets tend to follow the move generated from a breakout. Some others tend to go back and probably hit your stop loss. How can we decide the characteristics of a market? Obviously, every market is different and there is no unique way to understand what you do. But one thing that could be done, that I show you here, is to take a daily chart and to use a very simple strategy where you simply buy the breakout of last day's high, or you sell the breakout of last day's low. No stop loss, no take profit, simple, pure by a reverse strategy. Here you see some examples. Here we go short at the low of yesterday, then we turn long, then short again, long, and so on. This is not a strategy that probably will make money for you, but if you study this without commissions, why without commissions? Not because I'm tricky, but just because I want to understand the behavior of the market. So if the market is trending, has trending characteristics, this strategy should show some profits, because if I trade a breakout, that trade should try to move in the right direction. Right direction means the direction of a breakout in this case. If, on the contrary, a market is typically mean reverting, this approach, this basic approach, should most probably show losses, because every breakout will be a failure, not every single one, but most of them. So let's see some results of this. I don't know if you can read the numbers, but if you can't, okay, buy some new glasses. But okay, here are some future markets, and I have a ranking from the best to the worst. Okay, the best market is gasoline future, which shows very nice profits, $377,000 from year 2000 to some time ago, I don't know now. And the worst market is this one, ES067, is the mini S&P 500. This market loses $100,000. So obviously you understand that the approach itself does not show a common behavior. Some markets on the top of the list make money, interesting money. Some markets at the bottom of the list are a disaster. From this analysis, I understand that gasoline, natural gas, gold, platinum, DAX, heating oil, silver, crude oil are all markets with some typically trending characteristics. So if I want to trade a trend following strategies, I would probably choose one of these to develop more, because I know that their identity is stronger in trend following. On the contrary, at the bottom here, copper, 10 years note, and especially mini S&P 500 are a disaster in trend following, short term. So I would never put my efforts in developing a trend following strategy on a short term base on mini S&P 500, because it would require a lot of work for probably poor results. Why should I put my efforts there when I can easily find some better outcome on those other markets? So this is to say, this obviously does not tell you exactly, but it gives you a good idea about the behavior of the markets. And you see the enormous diversity of some markets. One is making a lot of money and one is heavily losing all the time. So here I get an idea in which direction I should develop. By the way, mini S&P 500 is a very efficient market because it has a lot of players, and the efficiency of the market is what it is keeping that from following the breakouts, because the level of price is normally the right one. Let's say it like, put it like that, okay? But now let's look at this matrix where we have the order in the middle of it, and then we have some points to discuss. Why, when, which, and exceptions. Why means, why am I entering the market? This is one of the questions to answer. Is there a reason why I decide to enter the market? And the answer to these questions may come from a setup. You might have a specific setup. A bias. What is a bias? A bias is sort of a seasonality of a market. If you discover that the market has a specific tendency to move bullish or bearish on some periods of a day, for example, you might decide to enter long or short, depending on your information, at the beginning of that period of the day and close at the end. And then random, you might even enter randomly the markets and then try to manage your position with some position and risk management. I don't recommend this because it's too much theory, but it's something that you could consider. Second point is when. When. I want to enter, but when shall I enter? There might be a best time of the day. If I want to trade a breakout, is it better to do it immediately after the market opens, or maybe it's better to wait for 2-3 hours to let the moves develop a bit? I would prefer the second. Best days. Are there some days where it is better to enter, or some days where it's better not to enter? Days depending on, again, bias. Maybe Tuesday is more bullish, maybe. So it's better to trade long, or days depending on some other challenge. Maybe I don't want to enter on Friday because if I go overnight, I don't want to keep the position open during the weekend. Just an example. And then chart patterns. Chart patterns are a great tool to decide if a trade has to be taken or not. Chart patterns tell us something about the recent moves and the behavior that might depend on these recent moves, and they give us then an information if it's good or not to enter the market after a specific setup. Order. Which order? Shall I enter with stop limit, market touch, mark? This opens a world. Depending on the type of strategy, you might decide among these. Normally, classical trend following strategies use stop orders or stop limit, while mean reverting use limit orders. A profit is a typical limit order example. You stay there and you wait, okay? Marked if touched are another kind of order where these are a substitution of a limit orders normally, especially on markets like the mini S&P 500. Once you put a limit order in the order book, you have the risk that the market trades at your level, but doesn't serve you because you have too many players there, and out of 1,000 contracts, 500 are eaten, but you are sitting in the remaining 500. So you stay there and you don't go anywhere. So if you use a marked if touch, as soon as the level you want to enter is touched, first of all, you send the market buy. In this case, for sure, you enter the market, but you will most probably lose one tick because you enter one tick worse. So it's up to you to decide. And then market orders. Market orders, obviously, you know what they are. That's the problem. Then the exceptions. We might consider some exceptions, and we might decide whether to code them. For example, I never enter the market during the main economical data release. First Friday of the month, unemployment situation in the States. I don't want to enter because too much volatility, all things like that. Okay, this is something I can code. Or something I want to use but not code. For example, Brexit. We knew about the Brexit decision. Why code that, which is once in the history? We simply switch everything off the day before. So this is a decision, an exception we decide to put in place, but we don't need to program it because we exactly know what to do, and it's not repetitive, so we just do it once. Now, after we did this, the analysis, we go into the testing, and now we show a real example of what we can do. So you remember the ranking of the breakout, and you remember the mini S&P 500 was the worst of all the markets to trade on a breakout. Perfect. So I can take this to trade and to develop a mean reverting strategy, a counter trend strategy. And I do so, I imagine to enter the market. Here are some mistakes, sorry about it. Verb without age, counter trend, but I mean, the development is missing a T. I'm sure you will understand it anyway. It's still easier than my Italian accent on English. So let's say there is a breakout of the highest high or the lowest low of the last 5 days. 5 days is a very important window of time because 5 days is a week of activity in the markets. So let's say after 5 days breakout, I decide to enter, but not in the direction of a breakout because I know that mini S&P is not good for this kind of approach. I enter on the opposite way. So if there is a breakout of the lowest low of the last 5 days, I enter long. On the contrary, breakout of the highest high, I enter short. I do the opposite of the breakout because I just discovered that mini S&P is not good for breakouts. These are the rules. The software here is Trade Navigator by Genesis company, but any testing is okay. I use this because it's very fast to write some types of rules, but any software is fine, of course. And this is the result from 97 to 2012, okay? We already get good results, 64,000. I mean, it's positive, so we know this is winning, okay? This is winning. And it confirms that counter trend is better on mini S&P rather than trend following. Perfect. Okay, but the equity line of the strategy is not really exciting. I mean, maybe you like it. I personally would not trade this because drawdown is a bit heavy and it's not very stable. So, okay, but never mind, it's positive, so I can work on it. It's positive. So, first thing I say, okay, let's take a condition where my breakout is a bit stronger. So I say that the close after the breakout must be at least 10% of the range far away from the lowest, from the level. It's not just one tick below or above the level of breakout, but at least 10% of the range, okay? So I want a stronger breakout. The results are pretty much similar. I got 64,000 before, now 63, so it's the same, but the drawdown increased and we see it from the equity line. Here we see it much better. This curve is still not the best in the world, but it is better than what we have seen before. I mean, in my opinion, at least, it's better. Perfect, no problem. So now I want to add a stop loss because I always trade with a stop loss. And here I have an optimization of different levels of stops. And the optimization is not run to find the optimum. It is run to understand how things change, changing the values of my stop size. Here you will see that no stop, 0 means no stop, shows good results. Very tight stops on the very left corner of the chart show losses. So again, the legend of tight stops to win are again bullshit. You can put a beep on this if you edit the video and I say this, but tight stops don't work. Then we see some profits and we have some stability zones here and here. Zones where changing a little bit of a stop does not lead to excessive changes in the results of a strategy. I will choose the first one with a smaller stop level, but this is absolutely flexible. You can choose a value here on the left or something here. I choose $600 just for the sake of exempling and developing here the strategy. With a stop loss, we get some improvement in the results, but nothing dramatic. But the equity line is again a little bit better. And this is a safe equity line because it is protected by stop loss. So here it's something we can at least know how much risk we put on the table when we enter because we have a protected stop loss. Now the strategy would be ready. We have a setup, an entry, and a stop loss. The strategy is ready, but I said there is a tuning phase, a fine-tuning phase, where we want to improve things, to clean up what we have, and to see if we can get something which is even better. First thing is the day of the week. Because I believe in bias, I've attended some Larry Williams courses, he works a lot on this, and I myself believe there is something. If we look at the results of a strategy on single days of the week, we see that end of the week, actually, we don't get very much. Apparently, it's much better to work on Monday, Tuesday, and Wednesday rather than on Friday and Thursday and Friday. Here, I do it now in the opposite way because I believe there is long and short difference. So I test long or short entries in the opposite way. I don't say now, this test is not how much do I make on the single days. Here, the results are how much do I make avoiding entries on a single day. 0 means I trade all the days. I don't avoid any single day. 1 means I avoid entering on Monday. 2, I avoid entering, in this case, long on Tuesday. 3, I avoid entering long on Wednesday, and so on. And this side, the right side, is the short entries. I skip no days, I skip Mondays, Tuesdays, and so on. Immediately, on the long side, we see that skipping Fridays is good. We see the best results, skipping Fridays. On the short side, I would never skip Fridays because you see that it's harming my results, but I could consider skipping Thursdays. We remember Thursday and Fridays were weak in the outcome, so I can decide to skip long entries on Fridays and skip short entries on Thursday. This is what I can decide. I do it now to see what happens, and we get this improvement, 86,000, like it was 68, I think, and this equity, which is even better than the one we saw before. So now we get a very important improvement in our strategy. Is there something else we can do? Yes. Be careful. I show you all these steps to show you the way I think. I mean, it's not a common rule, but you see, what's leading my development is mostly curiosity. I am curious about the market. So you remember I was talking about mini S&P, and we were talking about breakouts. Okay, but now my question is, when is a breakout more important? When there are more players or when there is nobody? Obviously, when there are more players. Mini S&P is open 23 hours a day, but there is a day session when the bell of Wall Street opens, okay? So we have a night session and a day session. If we consider only the day session of a mini S&P, so that we cover the session when the stock market is open, I believe that the behavior of that portion of data gives me a much more realistic picture of what the market is doing, rather than taking the whole set of 23 hours. Because during the day session, I believe that the moves are much more significant because they reflect what the big players are doing all over the market, because also the stock data are trading and everything is going on. So instead of considering the breakout of the lowest low or highest high of the last 5 days of the mini S&P, I take only the day session of the mini S&P. I'm still trading 23 hours, but as a setup, I take only the day session of the mini S&P. I call it my reference. What happens if I do so? I get an improvement, $10,000, 10% improvement. And again, if you remember previous pictures, a much cleaner equity line. So taking the day session only of the mini S&P to measure the breakout of the last 5 days gives me an improvement because my setup is more stable, more precise, and more affordable to get some good percentage of winners. We are still in the tuning phase. This should be my last tip. I look at the chart with the trades. This is a chart. here the losing trades are in red. I know that Chinese people prefer to see red as something positive, but this is a typical Western software, so the settings are different, but okay, never mind. What you can see here is that we have some periods where we have more losing trades in a row, you see. So it is sort of, I go against the market, but it looks like when there is a momentum or an acceleration in the market, I risk to place more losing trades in a row. So actually, I could add the condition that it's written in here that if I am stopped out, if I got a loser, I wait at least 3 days before entering again the market to avoid the rally phase. The rally training your phase is not pleasant. So I wait 3 days, expecting that in those 3 days, the markets will slow down a bit and go back out of that momentum mood, which is harming my counter trend strategy. With this addition, I get the same level of profit, but I get a much better average trade because I reduce the number of trades, but increase the quality of the trades and get a better line. You know, it's difficult to see from here, but if you look carefully at the numbers, you will see that there is an improvement. I was tricky. There is one more fine-tuning stuff here. It's not the last. The one is, well, I am in the market now. Shall I stay there forever? No, we see that after a certain number of days, we sit in the market. There is no benefit in waiting forever. And after, we can say 10, 12 bars days, it's better to close anyway because we don't get benefits later. So we add this condition and we close after 12 days, I think. And this is our final result. Now, we have to evaluate the strategy. Does the report show good values? Yes, it does. Is there consistency over the years? Yes, because the equity line was going up more or less throughout the period we analyzed. Are results replicable in normal conditions? Yes, because we have a setup, we do it the day before, the night before, and then we have all the time to place our trades. So there is no risk to not be able to do it, and also conditions. In real time, we can obviously trade it. There is no problem. It's not something developed out of 30-second bars where you have to place orders every 30 seconds and you could not do it manually or even not with a computer. And then are these results real or might be there some software bug? Well, in this case, there is no problem in considering them real, but believe me, there are many strategies where you get extremely good results which are not real because there is a bug in the software. As a rule of thumb, the better the results look, the more danger of a bug there is. If you have something which looks too good to be true, it probably is not true. And then, last but not least, is this approach in line with my personality? This is very important, because if you don't like to go against the trend, you would not be able to trade this strategy. You would feel bad. So you have to really sincerely consider if what you have here is something that you can feel good for you. And psychological strength is one thing. Drawdown is something. And financial strength. Do I have the financial and psychological strength to trade this? Do I have enough money to go through the drawdown periods? Do I have enough money to trade this with no excessive risk? Do I have a psychological strength to go through a $10,000 drawdown? All these things you have to put on the list and to answer with sincerity. You don't have to cheat yourself. Now I also put an out-of-sample check. The strategy was developed to 2012, which was here more or less, here somewhere. It kept on making money also afterwards. So it shows stability. We get now to money management. All we've seen has been done with one single contract, just to see how the market behaves. Now we have to put in place, based on risk, how many contracts we can use for each trade. There are many methods. I'm not explaining them here, obviously, but you need to consider it, and you have to be aware that this can dramatically change the result of your strategy. Just to give you an example, fixed ratio model by Ryan Jones with a delta of $5,000. Well, those who know the fixed ratio model know what a delta is. Those who don't, please go and study. Here you see the red line is the normal line with one contract. The blue line is the result having applied this model. And you see, we would have made $1 million the same period. Similar to this, fixed fraction with 2.5% risk, which is moderately aggressive, but still with one single strategy feasible. Again, you see the difference, $1 million profit instead of something more than 100,000. Position sizing can dramatically change the results of your strategy. Portfolio. This is an example, one approach on one specific market. You should try to mix sectors. Index, this was index, energy, currency, metals, soft bonds. Approach, this was counter trend. You should put together trend following and counter trend. Trend following on another market, obviously, because this one is not good. Trade duration, this is daily bars, maximum 12 days. You can put intraday, short term, whatever. And then you have to trade. Now the question is, okay, but how shall I trade? What shall I do? These are some platforms. Some of the most well-known platforms out there. Just as an example, I'm not promoting any of these, but just to let you know, TradeStation has own data with good history, so you have a good historical data set, a great community, and it's easy to program because the language is easy language, okay? As cons, not all the markets are covered because we know American people think that America is the world, so they don't consider very much about the rest of the world. Some markets are available but cannot be traded, and the technical support of TradeStation is very poor. I have to say this, it's true. Multi-charts, as you can use different data feeds, different brokers as well, and it's very flexible in position management because you can really put many strategies together. It's easy to program. Language is mostly the same as TradeStation. But it might be considered expensive if you have to purchase the license, the data feed, and maybe something else, then it starts being expensive. And then some bugs are not always considered by the support because they are not very flexible in treating the customers. This is what I can tell you. Trade Navigator is what you have seen in the development, has a great coverage of US markets. It's easy to program from daily time frame up. Intermarket programming, so building conditions to trade a market based on the behavior of another market, is very easy to program, and it's nice graphically to see. But it is low on intraday data, not even very flexible in programming, and if you want to program using variables, it's not the most intuitive tool to do so. NinjaTrader. It is very flexible if you are a good programmer. It has a very good technical support, and you can use different data feeds and different brokers, depending on version, because you know Ninja became brokerage, so they are more restrictive on this now. As a disadvantage, if you are not a programmer, it's not easy to program because it programs in C#. I'm not a programmer myself, so I have some trouble in this. If you use interactive brokers, there is no gateway interface. So you have a problem of daily disconnection. There are workarounds, but there is no official solution. And there is no portfolio tester, which is, in my opinion, a con. Any broker, it's very fast in testing, very versatile. You can really program everything. And it's very good, really good for portfolio testing. But it requires a hard learning curve. It's not easy to learn it properly. And it's not very flexible in real time. So to trade off every broker, you need to adjust things a little bit. MetaTrader 4 or 5, okay. Pros are data come from the broker. You don't need to purchase data. But it's a great community. It's free of charge, which is not bad. And it's very good, stable software in real time. It's a good software. But it's not easy to program. You need programming skills. And it has an approach to constructing which is different from any other platform. So it's a completely different mindset. So when you switch from this to the other world, you have some trouble. Cons, data from broker. But it was a pros. You say, you have it here, and you have it here. Yes, but why is this? It is an advantage because you don't have to pay for the data. But it is a disadvantage because normally the dataset is limited and it is broker linked because it depends on the broker. Sorry about my coughs. The quality of the data depends on the quality of the broker itself. How much capital to trade? This depends on the investment you have to make. And sometimes it's not just the money you put in trading, but also the money you invest. For example, you should probably consider having a cloud or a VPS. This is money you spend monthly. And then it depends on your risk profile. Forex is good for a small amount of money, not because of the leverage, but because of its scalability. Just to get you an idea, this is the technical setup of my cloud server, just to know how it is set up. Well, this was my insight into the automated trading world. Here you can get at this link some more information if you want. There is a PDF where you get some more insights about automated trading. This is free of charge, so you can get it getting the email down to this website. And I hope you will download it because I hope that you got some curiosity in what I do from what I presented now. Obviously, now you will probably ask me some questions, but I hope so. If you have other questions, you can send them all to Philip, and he will then revert them to me at his first occasion. Now I leave this and I'm back here with my face. Sorry for that.
Great, great. Well, that was really a very fantastic session, especially for me. I have not really been into systematic or algorithmic trading before, but what you have shared actually offers some insights to what could potentially be possible, especially from someone like me who has always been more of a visual trader. So if I could just put in some context, if we just put it, your systematic approach to how you actually trade in the trading competitions that you won. What was the similarities and what was the key factor that allows you or your strategy or your way of trading help you win the trading competition?
First of all, in automated trading, you can build a plan because you have your strategies. You know how they are supposed to perform, and you can base some plans on this because you can plan your path from January to December during the competition. You can plan the mix. In my first competition, I mixed 4 strategies together. I used on the DAX future and on the Italian future to intraday trend following strategies. I had a counter trend strategy intraday on the mini S&P 500, one good for counter, and an overnight trend following on Euro FX future. So I had already sort of a diversification and a small portfolio. Small because with $15,000 you cannot diversify enormously. But I was able to put these things together and to have a rough idea of what could happen so that I could also measure the results during my path and understand if things were going properly or if there was something to change.
I see. And so during the competition itself, it was based on real money, right? That is being traded.
Yes.
And would all those strategies and all those methods that you use be totally replicable to a real life in other asset classes, other instruments as well?
No, the main approach, yes. but then every single model was tweaked to the market where it was trading. So I had two trend following strategies on DAX future and Italian future. Very similar, but each had some slight differences to adapt to the market it was trading.
I see. So correct me if I'm wrong. So based on the approach that you actually advocate, we should always start with analyzing the characteristic of a specific instrument. And
Yes.
then we come up with a strategy specially for that particular instrument, rather than having,
that's what I do.
And rather than compared to having a certain strategy into algorithm and applying across different instruments. No, not that way, right?
My approach is to understand every single market as much as possible, and then to tailor suit for that market.
I see. And is there any possibility, because there's always this saying that when traders use systematic and algorithm trading, there is always this tendency that they were too much curve fitting, such that it appears so beautiful, but over the long run, it is not a robust strategy. Have you encountered that, and what's your take on that?
Tuning is okay to clean up from something. Too much is wrong, because you do it only to get the best appealing thing, but then in real time it will get broken because of overfitting. You have to find a good compromise, which is not easy. There is no rule to say no more than 10 conditions. There is no rule. It's based on common sense and experience. So obviously, the better the equity line, the more dangerous it is, because you will have put probably too many conditions and constraints into that. You better have something that looks good, not extremely good, but you know it is. It's Perry Kaufman says that loose pants, loose pants fit everybody.
I see. And I would suppose that things like winning streaks and losing streak will have a huge impact together with risk managed position sizing in terms of how the outcome on your equity curve is going to be, right? So what's your take on that? And based on the systems that you have developed over the years, are there occasions where you see losing streaks happening for a long time and there's a risk of ruin if you size too much, like let's say 5% or more than 5% average rate?
Yes. I got many strategies which went broken. So the proper position sizing, where I limit the risk of each trade, is the way to save my account. Because even when things go wrong, I'm still losing no more than what I can afford. That's the key. You have to risk and trade small, much smaller than you can imagine, because the losing strike is always behind the corner, you know. The risk of ruin is something that is very far from my imagination, because I risk very, very small. I never talk about leverage. I always talk about risk.
So it's based on
in my account, my margins are normally blocked by 1/3, 30%, when I'm heavily invested. So you see, I would not even need all the money I have on the account to trade what I trade, just because I am very, very conservative. You have to stay humble. When you think you got it to make you rich, it's the moment where you will start losing.
I see. So I suppose leverage for you only comes in when you know that you still have room for risk exposure, but based on the original amount of capital, it's not enough to open new positions, right?
Leverage is not something that comes into my mind. It never comes into my mind. I
see.
Always start from how much do I want to lose maximum if things go wrong? And from that, I size my position. Being this how much small, it will never occupy a sensible part of my account. You have never to start from how much from the account. You have to say, how much can I afford to lose? And then based on that, you calculate your position. 1, 2, 3, 10 contracts, just because in case of the worst case scenario, I will be losing so much. This so much, is it reasonable for me or not? Yes, it is. Okay, go. when it's too much, scale down.
I see. And I suppose for most strategies and algorithm, what would be your recommendation in terms of, or not say recommendation, your preference in terms of the maximum percentage to risk in any trade? Is it 2.5% or it could
I
be
cannot
up to
recommend
5%?
it because it's something that is depending on the risk profile of each of you. Personally, I measure not a single trade, but historically the worst day on a single contract base. And I measure my position limiting that worst day to 1.25% of my account. But this is my approach, is my idea. Somebody could prefer the worst week or the worst trade, change that 1.25 to 0.5 or to 3%. Obviously, the smaller the better.
I see. So you said earlier on that most of the strategies before you actually implement, you do back testing to at least see how whether it works well over the historical time. So when would be the time that you actually start to question whether your strategy is still working and whether you should do a review, fine-tuning or overhaul of the strategy?
Wait. There is no single way to do that. You can use some indicators of performance. For example, the drawdown. My previous times when I had few strategies, each of them I was running a Monte Carlo simulation to see what the average drawdown could be and the standard deviations. So I decided to stop the strategy if it was exceeding 2 standard deviations of the average historical drawdown. But this is not possible when I have 50, 60 strategies. So now today I simply build a ranking of performance of the strategies. And from this ranking, I get a number of strategies allowed to trade for the coming period, in my case, coming month. And all the others are resting and stopping. So I have an automated, let's say, selection of profitable strategies based on a number of conditions. When a strategy shows clearly to have become weak or not working anymore, it's better, in my opinion, to throw it away rather than trying to tweak it. Because when you take a strategy and you start tweaking the parameters, maybe you get a positive result, but that's normally overfitting. And then most of the time you get, after a while, better results on the old version rather than on the tweaked one. But I don't suggest to try to reanimate a strategy that shows a clear weakness.
I see. And I've heard traders on a systematic traders saying that you have to keep thinking about new ways, new ideas of coming out with new strategies as market changes, as environment change, as technology changes. So is that something you do on a regular basis? How do you actually come up with new things that pop into your mind? Hey, maybe I should try this strategy.
It's not really about new ideas. You might try new setups, more slightly new approaches. Looking at the markets every day, you might notice something. Oh, look, I noticed this. You go and test. Can I take advantage of this? But you have to explore new markets and try to understand more about what's going on rather than finding rocket science thing, because there is no rocket science out there. But you can say, okay, I noticed that on this market, there might be an opportunity to enter between noon and 1 p.m. So test it. Look at these kind of things, because if you find an edge somewhere, you can test it and use that till it goes, because not always things last. The higher the number of traders who discover some inefficiency, the smaller the inefficiency will become. It's new ideas mean you notice something and you test something around what you noticed, if that thing can make money. Then you have to verify if your new idea is maybe too much correlated with some other strategies you are trading. In that case, it's useless to keep it, because if you double your exposure on something, it's just doubling a risk.
And what, in your opinion, would be some of the reasons why some systematic strategies might lose its edge over time?
Because of the loss of the edge itself. There is strategies based their profits on inefficiencies. the higher the number of traders trading an inefficiency, the smaller the inefficiency, because there is always somebody who tries to anticipate to go out, and then you lose, at the end you lose this potential move that was there because you have too many people trying to do the same thing. It's like when you get a discount offer at it's at the mall. The more people go, the less items you will find left, and at the end you don't find any item at all because everything was sold out.
I see. And so that means, in a way, to find a strategy that has got that edge, it has to be contrary from a certain perspective. Because if everyone is pursuing the same strategy, the same rules, then the edge actually will start to lose itself, right?
Lose strength. So if first you had an opportunity to make 100 pips, then players come in, maybe it's 90, 80, 70, 60, and at the end it's no more enough to cover your costs or to cover generally your trading efforts, let's say, and it's gone. So you have to move somewhere else because there is no more real advantage in doing something where too many people are trying to do that thing.
I see. And in recent years, it seems like things like AI and machine learning has become a very hot topic in terms of using it to actually analyze the market and deriving some kind of strategy on its own. Or if, let's say, based on a certain strategy you have, machine learning over time might be able to improve the strategy on its own. What's your take on that? Do you actually try?
I'm not a fan of machine learning and not even AI. I don't like it very much because I think they are mostly overfitting tools. I strongly believe in the human action behind the tools we are using. I analyze with software, I put numbers together, but at the end it's still only me making the final decisions on what to put together. I don't take things that I don't understand. If I don't understand the reason why something could work, I don't trust trading it, because if I don't understand the reason, I fear it is just a coincidence. Things put together, you get something that works. I mean, I don't trust that. So all the AI tools or machine learning tools normally do this. They find something because they dig very much. But is that something real? Or is it just a coincidence? In my opinion, it's more in the coincidence sphere, and I prefer to keep an eye and power action on top of the development as a human being. In my opinion, we are not yet so far to really delegate the machines every kind of choice in trading. This is my personal opinion, of course, but I've not seen really successful AI guys out there so far. I mean, maybe I ignore it, maybe I'm too stupid, but to my knowledge, I've not seen any revolution there as of today.
I see. So right now, in your usual daily or daily trading, do you still encounter anxiety despite the fact that you are using pure systematic and algorithm? Do you have any kinds of occasions where maybe because Trump did something and you felt like, well, maybe my system is going to be at risk of something, and you decide to stop and pause and do something about it? Has that occurred to you?
No longer. I have a temptation sometimes, of course, if it uses, but I try to stick to the routine. I do that only in case I see that it is clearly behaving wrongly, that it is doing something wrong technically. So then I say, okay, there's something wrong, there's a bug. In that case, I stop it. But if it is just losing because there is a losing strike, no, I keep it alive because I stick to the routine. In the past, I noticed that making decisions of this kind normally were producing poorer results overall than letting the machine do what it was supposed to do.
I see. So events that happen overnight and black swan events and financial bubble and crash and stuff like that, you will just still continue to trade through your system as though that it is supposed to run as per
that's a bit different. If there is a major event where markets are disturbed by the event, I might decide to stop everything. But it's different because my systems are based on the nature of markets. because I studied a single market. So if the markets are disturbed so that they behave differently, like if you go out and you drink too much, you are drunk, it's not Philip anymore, it's a different version of yourself, and maybe discussing with you in that occasion is not very productive, you know. So the same case of the markets, with a difference that I will also be losing money maybe. So if I expect that the markets will have a different behavior than usual, because of this major event, I might decide to stop everything. As said, Brexit, American election, and all things like that might change things for a while, 2-3 days, 1 week, something like that. In that case, you might decide on certain markets just to put it up, but this is a specific exception. If there is something like Fukushima or that kind of disaster, you can keep everything running because normally the effect is exhausting quickly. Normally, today.
I see.
Which is not nice, I mean, because it shows that there is no real sorrow about what's going on from people. But reality of the fact is that also when we have terrorist attack today, there is no longer an effect on the markets.
Yeah, because it's become so common.
It's becoming cynical. So it's normality, which is very bad from one point of view. But if we look only at the markets, that's what's going on.
I see. So in most circumstances, there's no reason to stop the system from running, except that if you anticipate
in my
that.
opinion, yes.
I see. I see. Great. So it was really wonderful for you to share with us so much useful information. So before we end off today's session, would you have any kind of advice, maybe three tips you have for any trader who has been trading for a while and is really keen to go into systematic trading? What top 3 advice and tips would you have for someone of that nature?
My general advice for any trader, not only systematic trader, is to stay humble. Stay humble because you have to be careful when you lose, obviously, but also when you win. When you win very much, stay humble, be careful. You're doing something wrong. If you're winning too much money, you are doing something wrong. You are probably overexposed. Once in your life, in the right direction, but be careful because it will revert sooner or later. Very obviously, if you really want to learn about automated trading, there are resources out there. And myself, I have the Unger Academy, so I promote just a little bit. You find a lot of resources, but I have also my YouTube channel and Facebook page where there are free resources. You have free videos just to start getting tips about the day-by-day happenings of a day trader. Don't underevaluate the power of automated trading, but don't even underestimate it because, or overestimate depending on the conditions. It does not make any miracle. Don't think that just because you are working through an algo, you become profitable. The machine is smart, but not so smart to put money in your pockets. It's not a slot machine, or maybe it's a slot machine because if you play, you know that you never win, but it's not the ultimate miracle and solution to trading. It's a way to overcome some psychological issues, to get a proper way to plan your trading style, but it's not something that makes you George Soros of tomorrow. It's something that helps. I chose that because I have a mathematical mind. So if you like it, you can approach it. You don't need to be absolutely a very skilled programmer to start automated trading. There are just some basic knowledge things that you need to know, but you don't need to be a wizard of computer to do it. You need, first of all, passion. Please don't trade for money. Trade for passion. Because if you trade for passion, you will do it happily and you will overcome the bad periods. If you do it for money, there are many other ways to make money out there, which will get you less stress. Money is not easy to make, but trading is one of the most difficult ways to make it, in my opinion.
Wonderful. That was really a good advice. And I think it really brings a lot of traders back down to earth in terms of the kind of expectations.
Yes, the expectations are always too high.
Yes, and I think that, and that is exactly what we are trying to achieve in this online trading summit, not to let traders feel that it's an easy thing to just participate in some strategies, holy grail, and you will make a lot of money from that, but really teach them what is the difficult thing about it, but it can be done if you really set your minds to it, actually. And thank you again so much, Andrea, for your time today. I'm very sure your teaching is going to be very helpful to the summit participants, and I wish you all the best in whatever that you do, and hopefully I will have a chance to interview and to chat with you and do some kind of presentation with you again in the future.
Thank you for inviting, and thanks to everybody who has been listening to this. I hope you enjoyed it, and stay humble. Be careful.